retirement scheme. Have you heard of it? Voluntary retirement scheme. Sometimes the employee, they want to retire from the job before the actual due date, right? And both it is beneficial both for the employee as well as for the employer. The employer, he may decided to retrench or to reduce the number of staff. So when the employee applies for the VRS, voluntary retirement scheme, before it is due, the employer, he will prefer to allow him to go on retirement. But whenever there is a retirement, the company, the employer, they have to pay a lump sum amount to the employee, right? That is known as compensation. And remember, the compensation paid to the employee or this process, VRS process, is not an operating activities, right? But since he is an employee and related to the business, it is an operating activities. That part is fine. But voluntary retirement scheme is not an operating activity. But we have paid means we must have debited to profit and loss account, and there must be some outflow of cash. Both are important. There must be some outflow of cash. So it is an expenses for us, but not a revenue expenses. It is an expenses for us. We must have debited to profit and loss account, and there is an outflow of cash because we have paid the money. So how it is to be treated? While calculating profit before tax and extraordinary item, what we will do? Now we have debited the compensation paid to the profit and loss account. My profit has been reduced, so it is to be added. So you will add extraordinary item, and you can write BRS. It will be better. Completely don't write in the short form. So it is to be added here. That part is nullified. And the second thing, so while paying the VRS amount, we have paid the amount to the employees. So there is an outflow of cash. So far as treatment of the amount which has been debited to profit and loss account, we have done it by adding it at the time of calculation of profit before tax and extraordinary item. But since there is an outflow, it is to be treated once again where? While calculating the cash flow from operating activities at the end, what we will do? We'll calculate the cash flow from operating activity before extraordinary items, and here you'll write the VRS or voluntary retirement scheme or voluntary retirement compensation. Don't write in the short form. Voluntary retirement compensation. Whatever amount you have paid, that is to be deducted because there is an outflow of cash. And now the net amount, either it will be cash flow from or cash used in operating activities. Right. These two items are very important so far as cash flow is concerned. That is voluntary retirement scheme. That is very rarely asked, but loss by theft, loss by earthquake, these are very common items to be treated. First of all, while calculating the profit before tax and extraordinary item, that is to be added the loss which has already been debited to profit and loss account, and the claim which has already been received to be deducted. And at the same time, while calculating the cash flow from operating activities, the amount you have received, that is to be added back. Right? So these are one of the most important items. Another item is there in the cash flow statement, that is proposed dividend. Proposed dividend means the dividend which has already been decided to pay but not yet paid. Once the dividend is decided, thereafter the AGB or annual general body meeting of the shareholders will take place. They'll approve it, and once the company gets the approval, then only the company will pay the dividend. So normally you'll get the question in this way. Suppose this is the balance sheet, 31st March 24, 31st March 25, right? And here it is given proposed dividend. Proposed dividend. Last year it was say 30,000 and this year it is 47,000. What does it mean? It was decided to pay 30,000 rupees dividend for the year ended 31st March 24. But it can be paid only after approval by the shareholders in the AGB. So normally what is the procedure after 2024, 31st March 24? It is expected that a meeting must have been held and it must have been approved and paid. But so far as this 47,000 is concerned, it is done on 31st March 25, that is the current year. It is expected to be approved and paid in the next year. So treat this one, this 47,000 will be treated as contingent liability. Contingent, may or may not be approved. It is contingent, so you need not to treat it in any way. It is not to be treated in any way. So what is to be done? While calculating profit before tax and extraordinary item, this 30,000 rupees is to be added back. Why? This amount must have been paid during the current year. It is a non-operating expenses because paying dividend is not an operating expenses for any organization, both for finance and non-finance. Dividend is paid only against issuance of shares, and issuing shares cannot be an operating activities for any organizations. It is absolutely a financial activity. So it has been paid this year. It has reduced my profit. So it is to be added back. Well, it is to be added while calculating profit before tax and extraordinary items. That is to be added back. And at the same time, this amount will be deducted in the financing activities because there is an outflow of cash. So to be added at the time of calculation of profit before tax and to be deducted at the time of from the financing activities. Number one. Number two, apart from this, sometime some more items will be there like unclaimed dividend. Unclaimed dividend. What is it? Unclaimed dividend means suppose it is given 6,000. Unclaimed dividend means dividend declared, but the holder of shares, those who are entitled to receive 6,000 as dividend, they are not traceable or they did not turn to receive the money. So as a result of which we have not yet paid. Since we have not yet paid, there is no outflow of cash. So how much we have paid? We have actually paid 30,000 minus 6,000, that is 24,000. So now what we will do? While calculating profit before tax and extraordinary item, add this 30,000 because we have set aside this year to be paid, but actually paid is 24,000. So while calculating profit from cash flow from financing activities, you have to deduct 30 minus 6, that is 24,000. So 30,000 to be added while calculating profit before tax and extraordinary item, and 24,000 rupees will be deducted from financing activities as dividend paid. Right? One more. Now suppose in the question, instead of giving the dividend amount, the question says that equity shares, say previous year it is 1,20,000 and this year it is 2 lakh. And the question says additional shares were issued on 1st April 2024 on the very first day. And one more question is there. Dividend is paid at the rate of say 10%. Sometimes the student get confused that how to calculate the dividend when the date is given. Remember, dividend is always calculated on the opening balance, that is previous year's balance. So here the dividend will be calculated on this 1,20,000, 10% on this 1,20,000. At that time, don't argue or don't develop that the additional debenture shares were issued on 31st, sorry, on 1st April. That is at the beginning. So still then we cannot uh, allow them to receive the dividend. Dividend will be paid only on the opening balance. Opening balance is 1,20,000. So dividend will be calculated on this 1,20,000 at that of 10%, that is 12,000. So while calculating profit before tax and extraordinary item, the 12,000 rupees added, and while calculating profit from cash flow from financing activities, 12,000 rupees will be deducted. That's all. So these two items are very important. One is proposed dividend, and another one is that is extraordinary items. While calculating cash flow statement, be careful with these two items, and these are very, very important. In the next class, we will discuss about the treatment of depreciations. Some difficult items are there, twisted items are there, which we will discuss. Now, if you like the video, the way we describe it, I hope you must be getting it. So kindly like the video, share it with your friends, and join us in the next video. Thank you.